All right, welcome to the Real Vision Daily Briefing. My name is Weston Nakamura from Tokyo, Japan. It is Tuesday, May 3rd, 2022. I am filling in for Warren Pies, and I'd like to welcome Mr. Warren Pies, founder of 314 Research. How are you, Warren?
I'm good. Nice to talk to you.
Yeah, indeed. So Tommy Thornton will be back, and so you were supposed to kind of be in this seat. Instead, I'm going to be kind of grilling you. Well, I'm not about grilling per se. Yeah, let's just go through some of the overnight data. So in Asia, you had Japan, China closed. The Reserve Bank of Australia hikes rates by 25 basis points, which was more than surveyed expectations. This is the first hike by the RBA since 2010. RBA Governor Lowe was fairly hawkish, and you saw Aussie dollar rallying nearly about 1.5%, as Aussie yield spiked. Europe slightly in the green at the close. Euro stocks ended up about 0.5%, led by energy. 10-year German yields are now above 1% for the first time since 2015. And then it seems like U.S. Equity indices, which opened flat, are closing about 0.5% up on SPX. VIX is dipping below 30. 10-year real yields are back in positive territory. And we wait for the May FOMC policy tomorrow, where we're expected to get a 50 basis point rate hike and potentially rather hawkish Powell press conference thereafter. Also on the data front, U.S. job openings rose unexpectedly to a record 11.5 million. So that's the setup going into FOMC tomorrow. Warren, A, did I miss anything? And B, what are your thoughts heading into FOMC tomorrow?
I think that was a good rundown of the daily kind of state of affairs. I'd say that we've been in a bear market this year. This is kind of what we expected. And then the rally coming off the March lows into kind of the most recent swoon has been kind of confusing. We spent some time trying to figure that out. When we get zooming in really close to the last 24 hours, we had the Treasury come out and make an announcement. I don't think it's a huge deal, but basically underlying tax receipt data that we've been following and tracking came in strong. And so the Treasury issuance of new debt is going to be lower than the market expected. And so I think that, the market read that as a potential cap on more of the back end of the curve for rates to not run away from us. And right now, it's important to kind of keep the big picture simple, which is that, you have true inflationary concerns that are pushing on Fed policy, pushing on political pressure, which has been pushing on Fed policy. That's driving interest rates higher. Interest rates goes higher, and you see, a whole host of assets where valuations have been predicated on low rates for many years, and so we have a repricing going on. And at the same time, obviously, I think we're all kind of like a frog in boiling water watching the Russia-Ukraine crisis and realizing we need to keep that in the front of our minds and realize that every day brings us closer to a full embargo of Russian energy and oil. And I'm writing this week's report, and I said in the intro that, coming into the year, it was an infinitesimal risk of stagflation, and now I think it's a coin flip that we get really brutal stagflation. And so it's the way I see it at this point in time, and happy to go into any of those topics with you.
Sure. Yeah. No, I think that was pretty. I mean, so just on that point too, U.S. nat gas did touch a new high in terms of its sort of recent rally that we've had year to date. But yeah, let's just take a look back at especially the month of April was pretty brutal for equities globally, and then obviously the first quarter of the year was, I believe, it was the worst on record in terms of fixed income returns. That's not good. And so with that said, it's kind of reading through your report that you put out. And first of all, I really like your steelman sort of approach. Last time you were actually on the, hosting the Real Vision Daily Briefing, you said that, at 314 at your firm, you have this steelman thing, this opposing argument, right? By which, correct me if I'm wrong, but you're using the term within the context of the phrase, a straw man. So basically you're trying to proactively construct like the strongest argument that goes against your own thesis or your own views in order to expose or to bring out or bring to light, your blind spots or your potential like personal risk exposure. Like basically a mission to find like what are you missing, right? So by that definition, are you, what do you, I guess, what do you look at? What did you find in your sort of Steelman analysis? And do I even have that interpretation correct?
Yeah, you said it perfectly. I mean, I think it's common for strategists, for humans in general, to kind of get, wedded to a position. And you almost see it if you watch enough of these shows and stuff. You hear it, perma bull, perma bear, an inflationista, deflationista, people who believe a certain thing. And when you once you make this forecast, your ego gets wrapped up into the forecast. And when that happens, it gets really difficult to back away from any forecast. And that's a really tough position to be in. You need to have flexibility. Flexibility is a huge advantage in this game. And I would say even like a decent model is better than no model, because a model shields your ego in that way. It's like I'm not making this call. This is what my indicators are saying. This is what the data is saying. It's really important to have that distance when you're trying to navigate these markets. And so that's something we do. We try to be really conscious of that and blind spots that could develop and turn into a bias. So we've been pretty bearish. The first bearish report we wrote was in late August of last year. And we said 2022 is shaping up to be a tough year. And then by the time we wrote our outlook, we were pretty bearish on the year. We thought that we would see a Q2, Q3 steep correction. In the view at the time, now granted this was before Russia-Ukraine, which is it changes all of this analysis somewhat. We thought that the Fed would back off of their tightening cycle. The Fed put was somewhere between 3,800 and 4,000. We did a bunch of analysis and interspersing credit spreads with equities and how equities lead credit spreads. Equities lead high yield credit spreads, which high yield lead investment grade credit spreads. We did a bunch of analysis there. We looked at yield curve inversions and how long that lasts until the Fed backs off. And so we had this whole Fed pressure scorecard. So we've been bearish, and then Russia-Ukraine happens. Russia-Ukraine, my background is as an oil analyst. For years that's what I did it, and so we quickly realized how serious this issue was for global commodity markets. And already prior to that, we've been recommending having an overweight in energy as a hedge to a lot of the things we saw developing anyways, and that just supercharged that trade. So we've been bearish on the markets and in general, and bullish on very small pocket of oil and energy for the year. And so we wanted to make sure we weren't getting, then we had this big rally off the lows in March. We wanted to make sure that we weren't missing something. So we did this kind of what we call a Steelman approach, which you described well. And, we found that this is especially helpful when, you're in consensus, which at that point in time, bearishness was the consensus. So have some self-awareness and realize, at that point, AAII survey was at like 15% bulls, which is like a 30-year low. And when you look at some of the other things we thought that were, ostensibly bullish, we model different types of investor portfolios at 314. And if you're running a vol targeted strategy, which is pretty common, you would have de-risked quite aggressively through the middle of March. And so we were at levels that have historically marked, intermediate term bottoms. We have an asset allocation.
Actually, on the
sure.
Let me just cut in right there, because Brian, can you pull up chart 1? This is from, as always, I like to steal my charts from my buddy Craig Peterson at Tier 1 Alpha, but he studies this very carefully. So this is basically just a chart of S&P realized vol, and like market day-to-day declines or advances. And so the argument being that as realized vol continues to trend higher, vol target strategy or risk parity type of strategies, for which there's over $1 trillion of AUM, or there was at one point, attached, that will de-risk because of that's how their models are designed to do. Much to what you were saying before about how you don't invest based on ideology, you just invest based on rules based or system. Well, so that's what's contributing a lot of this, I guess, if you want to call it an orderly downtrend, or this bear market, or whatever we are in currently on SPX. So I just wanted to pull that chart up. But it seems like in your report you were saying that these vol targeting strategies, yeah, they indeed have been selling off because of realized vol. However, they are at a point in which they're done selling. Is that correct?
Yeah, I mean there's a nuance there. So we were at most of the time where we're at we were doing 10% targeted vol, and we were doing a 20 and 40-day blended look back, and most of the time you see we're at 40% exposure on those, and that's just another fancy way of looking at realized vol, truthfully, and trying to put it in like portfolio management terms. But we were at 40% exposure, which is a usual decent place to buy, but that's not where you would really want to get if you were looking for rock bottom positioning. 25%, which is where we were at the COVID lows, for instance, and a few other times at major lows during history. And we have some studies we showed around those 25% levels. So there was de-risking, but it wasn't enough ultimately in the report to jump to the end. Is like we examined all this bullish evidence. We didn't convince ourselves to turn bullish. So we remained in the bearish camp. The other things, just really quickly to walk through the things we did find that were bullish, and then I'm going to walk through a new bearish development, which I think frames up the stagflation stuff. So we saw, TINA is a well-known thing. There's not very many places to put your money. If you run, Brian, if you put the drawdown of a 60-40 portfolio up on the screen, basically the 60-40 portfolio has already experienced as much of a drawdown as it did in 2018, which, by the time we got, not that one, it's going to be the last one I sent you. Maybe you don't have it right off. It's okay. It's not a big deal. But basically the drawdown of a 60-40 portfolio, or traditional 60-40 portfolio, has hit the levels that that we saw at the end of the tightening cycle in 2018. So we're already, the Fed's jawboning has already pushed us into this world where stocks and bonds are selling off together, and equities look relatively, compared to bonds, probably better. So
right,
that was
and just to clarify too, like the risk parity is basically almost like a 60-40, but levered on the the 40 side, and then you have like the move index and rate vol exploding as well, and so that all kind of ties in together. They're basically the same strategy, or cousins of one another, that are selling off together.
Exactly, and that's what our model, when it rebalanced, and we have a hybrid version of risk parity in our asset allocation model. We use hierarchical risk parity, so it's a little bit different, but we still end up looking at vol in our stuff. And in coming into May, it went heavier into equities and lightened up its bond position, and that's something that you see mechanically happening throughout the markets at a larger scale. So I mean, this is a real phenomenon. Couple other things. I mean, despite the fact that we saw the index down only like 10%, 13%, whatever it is, under the surface, obviously there've been a lot of profitless tech companies and kind of bubble type of stocks that have already been taken out behind the woodshed, and so there's evidence of the bubble deflating. Macro momentum, we talked about the tax receipt data, how strong that's been. We saw that flow through in the Treasury issuance guidelines yesterday. And then the other thing, which is not probably popular around here to talk about, but if you look at the implied inflation schedule from the TIPS market, inflation break-even market, you can see that really the way the market, we've seen break-evens rise, 10-year break-evens and 5-year break-evens especially have risen a lot since the Russia-Ukraine war. So we break it apart here on this bar chart, and we look at where were we on each year's forecast by the bond market of how inflation will go. And then we look, the blue bar is pre-invasion, purple bar is post-invasion, the gray bar is the most recent data point we had in this report. And the key thing here is that the bulk of the move, 85% plus of the move we saw in 10-year and 5-year break-evens, occurred from inflation happening in the next 12 months. So this was like a big pig in a python of inflation coming through the market. And the big question in my mind is going to dictate how how quickly you want to get back into the market and get some kind of risk asset exposure, or even bond exposure in general, is will this inflation schedule hold, or will some of that next 12-month inflation creep into, 12 to 24-month inflation, what we would call, 1 year, 2 year forward, 1 year, 5 year forward, anything outside of that next 12-month inflation, will that creep into those out years? And if it does, then we start seeing a structural shift in this inflation outlook versus something that is honestly a little bit more transitory.
Right. Actually, yeah. So on that note, so I have a clip here from. So this is an interview with David Rosenberg from Rosenberg Research and Associates, being interviewed by Alex Gurevich, very famous hedge fund manager, rate vol trader, and they basically talk about how the Fed is essentially has a pretty high probability of putting the economy into recession. Just take a look at that clip.
If I didn't have the conviction in my call, and like I said, there is no such thing as a sure thing, but I do have conviction in my call. I am not 35% recession. I am 80% recession odds for this year, 80%. Now people will say, well, what happened to the other 20%? Well, the other 20% is that there's things that could happen. And if we get some exogenous shock or something happens to cause inflation to start to come down more quickly, the Fed will not raise rates to the extent that's priced in right now. The Fed will not do what it's pledging to do right now. And that could be, the soft landing scenario is that for whatever reason, inflation comes down and the Fed recognizes it in time. I have lots of reasons to believe that inflation will come down. I just don't know if the Fed is going to see it in time. They're so prone to making policy mistakes in both directions. But there is a 20% chance that we can emerge from this with a soft landing. I'm not saying it's 0%, but then you've got to ask yourself the question, and you're the portfolio manager, well, if I believe in Dave Rosenberg's view of 80%, understanding there is no such thing as 0 or 100, is my portfolio and my asset mix positioned for an 80% chance of recession?
And that was David Rosenberg being interviewed by Alex Gurevich. Just as a sort of programming note, I also want to mention I actually have a video coming out as well in which I give my personal takeaway on some Real Vision content. I used to do this on the Real Vision Exchange a lot, and so this is the actual video that I did this sort of the first one of those on. But so Warren, what Rosenberg is actually saying is that if you just look at history, so essentially that you've had 14 in the post-war era, the last few decades, you've had 14 Fed rate hiking cycles, 11 of which ended in recession. And so the Fed's, I guess if you want to call it batting average or whatever, in terms of driving the economy into a recession during tightening cycles, is about 80%. That's where he's getting his 80% from. The other 3 out of the 14, those were the soft landings. So 20% chances of a soft landing, 80% chance of a recession. And then he also looks at markets, and markets are currently priced at approximately 30% pricing in recession. And so therein lies the mispricing and sort of discrepancy. So any thoughts on that? I mean, I know that, you were, we just went over your the holes in the bearish argument, and so therefore the bullish argument. But how does that stand up your current actual view? I guess you're still bearish on against David Rosenberg. It sounds like you guys are kind of aligned.
Yeah, I mean, I don't know about putting an exact percentage on it. We ran some recession probability models, and we definitely saw like a 3-fold increase from January through end of March. But the big thing is we're just seeing cost pressures skyrocket, and it's from the Fed and it's from the war. And those are the 2 major, and there's some supply chain stuff too, but the cost pressures are skyrocketing. So we have, mortgage rates shooting up. At the same time, oil prices are skyrocketing and food prices are skyrocketing. So what we have is really the beginning stages of what I think could be a stagflationary period. So you would see growth decelerate and start to roll over. If you look at headline, another chart I passed along to you, Brian, headline versus core CPI, what we're calling the CPI spread. So headline CPI includes, food and energy. Core is, strips out food and energy more or less. And so if you look at these, this one is the one with commodities, you can see that the spread between headline and core moves with commodities. And so this is kind of what we've hit this 2% spread on the headline versus core for the only the fifth time, distinct time in modern history. If you go back into the 60s, this has only happened 5 times. So it's like 1973, 1980, 2005, 2007, and 2022. Those are your cases. So these are, and if you look at the next chart, which is market performance for the next 2 years, not that one, the next chart that shows market performance is 5 lines over the next, there you go, over the next 2 years. You can see these are volatile times. Like the lines can go over the place, but the history of these periods is a lot of volatility, sharp drawdowns. You know, the Fed's having to fight with inflation, and consumers, ultimately your liquidity is being stolen by these cost pressures. So yeah, I think all this is part of what we wound up back in the bear case, is because we don't see a quick resolution to the war. We don't see any way for, even with the China lockdowns, oil's above $100 a barrel. So, you know, the cost pressures on the U.S. consumer are tightening everything really quickly here.
Yeah. So on that, by the way, I really like that analysis, that spread, the core versus headline spread analysis that you did. So I have a question here from YouTube. Question for Warren Pies: do you see demand destruction affecting and hurting the price of XLE or other oil stocks in the next 6 months or less? Just kind of go off that last point you were making.
No, I don't. I don't think we're there yet. We're at $100 a barrel, and that's with, you know, China doing intense lockdowns. Now, I think the only way I've said this from the get-go, is that when you look at historic recessions, you know, we think when the dust settles off of the sanctions, self-sanctions, everything that's happening in Russia, Ukraine, you're going to see about a 4 to 4.5 million barrel a day gap between global oil supply and demand. And we have no precedent outside of the COVID lockdowns for a case of recessionary natural demand destruction of that extent to close that gap. So that's already the perfect setup for stagflation. The one tool in the toolbox that's new here is lockdowns to control oil consumption. And it's not conspiratorial, I don't think, but you know, in China, there are COVID lockdowns going on, and to think that the Chinese Communist Party has not thought through the knock-on effects for commodity prices and for their own economy and for domestic consumption goals and things like that, I think that would be short-sighted. I think they've considered all that, and even with that lockdown, you're seeing oil above $100 a barrel. So I think that the rate of change on demand is most likely higher, and the rate of change on supply is most likely lower. So no, I see the price of oil going up. I think energy equities are continuing to get re-rated. There are a lot of just like generalists and technicians who want to fade the rally that we're going through right now. And quite honestly, I think we're at the early stages of a big bull market.
Nope. Yeah, because John Kitcher from the RV site is also asking the same thing about, you know, is a long energy position still warranted? It sounds to me like you're saying it is. Personally, actually, though, you kind of reminded me of, you know, this is actually in the video that I was just talking about my takeaways from that interview with Rosenberg. But there actually is, you know, a kind of a risk to the long energy trade, in which, again, China, going back to what you were saying, because China has this increasingly hard to defend, you know, policy of zero COVID, that actually provides this, like, you know, a potential switch that exists in which inflation expectations could flip immediately if Xi Jinping just decides one day in his mind and therefore through policy that COVID zero is over. You're going to get a huge repricing, maybe temporary, but huge volatility in repricing in commodities, in energy stocks, and all that. And that's, you know, that exists, right, as a risk. So I'm not saying that it's going to happen or anything like that, but something to think about. You know, it's just one person who can just literally flip the switch on inflation expectations globally.
Yeah, you mean to release the lockdowns that are in place right now, or to
right?
So you're talking about an upside risk to energy. Yeah. Oh yeah. I think it's a rate of change thing, and we've already seen the oil market's been hit with a bunch of different bullets. We've had SPR releases, lockdowns all over China, and we're bulletproof. We're over $100 a barrel. It's impossible for me to overstate how big of a deal that is for this market to be where we're at, despite what's been thrown at on the demand side. So the next move is for demand to go up. What's going to happen when SPRs? We've already drained 30% of global SPR fighting this battle. So a lot of bullets have been shot at this market, and it's still holding up. I think that's a huge signal that everyone should pay attention to.
Yeah, let me just throw one more question at you, Bob, from the RV site. Thoughts on gold miners and silver? When do you think they shine, Warren, if they do?
We have a chart on, I think gold miners are going to more or less follow gold, and gold's been, the thing is cost pressures for miners are going up too. So, if gold stays steady while the rest of the commodity complex goes up, historic analysis that I've done in the past shows it's not the best environment for the miners. But if gold's keeping up with the inflation that we're seeing, then they'll do well. The chart we're looking at here, another big story we didn't touch on so far this year has been the U.S. dollar and kind of the fall of the yen and the euro versus the U.S. dollar. And historically, the dollar index and gold can't live in a bull market together. And that's what we're looking at on this chart. Is we're looking at just 63-day rate of change for U.S. dollar versus gold. That's all the blue dots. We put in the red dots with a best fit line for this year's performance of these two assets. And you can see they're moving together. It's a totally different relationship. And so, we are bullish on gold. Our model is technically neutral right now, but I think the breakout above 1950 was meaningful. I know we're back below that now, but I think it's still a slow grind higher for gold. I do, and I think that ultimately the Fed's going to have to, just like Rosenberg said, and a lot of people are starting to look at, is that this is an asset-based economy at this point. It's a consumption-based economy. The consumption's being fed by asset price appreciation. And so when rates rise, asset prices drop, consumption gets hit, ultimately gold, just like in 2018, is going to look through the tightening cycle and be the first asset, the canary in the coal mine, to realize the Fed's going to have to, we're stuck in a stimulus loop, and the Fed's going to have to re-stimulate the economy at some point, or back off the tightening at least.
Fair enough. Any thoughts on the Treasury market, I guess, in the kind of the near term? Are we oversold here?
Yeah, I don't want to. We are oversold, but you can get more oversold. I think that I could defend a bond, getting longer bonds here soon, but given the inflation schedule we just looked at, for instance, and that maybe the market's getting a little ahead of itself on certain things. If I wanted to make a play, though, on lower interest rates, I think I would look at, this is kind of out of consensus at the moment, but I would look at things, and we haven't published this as a trade yet, it's something I'm looking at, is things like home builder stocks. If you think that we're going to get a move lower in long rates, there are some attractive places, I think, in the market where you'd have a lot more. There's a better risk reward to the trade. Let's put it that way. If we're really going to get a back off in interest rates versus owning the treasuries themselves, not so attractive to me yet. It's one of the lowest weighted assets in our model right now.
Right. Personally, so Japan Golden Week is going on right now. Japan is obviously one of the largest foreign creditors to the U.S. and one of the largest buyers seasonally right now. And so currently, you're probably, this is probably why you saw, treasuries break into that 3 handle yesterday with, the Japanese investors stepping out, going into, or, coming out of Golden Week for a short-term trade, post FOMC tomorrow and all that, depending on, as long as the markets aren't too crazy and volatile thereafter, being long, the long end of the curve for a shorter term trade is something that I would be very much looking to trade personally. But yeah, we'll see what happens after that. Any final thoughts, Warren, as we head into the May FOMC? Anything that you're looking for in particular?
We'll just have to, the tone of I think that 50 basis points is what we get. I think that's, it's pretty consensus. The Fed doesn't want to surprise the market either way. And so my looking forward and through the meeting, though, I still take the under on this kind of like hawkish craze that's taken over forecasters. I just don't think we get to that end of that cycle where they're pressing up whatever it is, 4 straight 50 basis point hikes. They're going to break something, in my opinion, and they'll back off.
Yeah. So let's see what happens. But Warren, thanks for joining us today. And to all of you, thank you for the questions. Thanks again for watching the Real Vision Daily Briefing. Maggie Lake will be back tomorrow with Darius Dale following the FOMC. My name is Weston Nakamura, and thanks again for watching. And thanks, Warren.
Thank you, Weston.
It's a really complicated world out there. We've got massive inflation, recession fears, war in Europe, COVID, China issues. What the hell's happening? Everyone's got an opinion, but who's right, who's wrong? As co-founder of Real Vision, I've got my own view, but maybe I'm wrong too. And I want to go and find out more from real experts, real in-depth analysis. And I've hand-chosen my experts for this 2-week journey of discovery in global recession. Is everyone wrong? I've chosen people like Peter Zeihan to talk to him about geopolitics, David Rosenberg about the economy, and Pierre Andran, the world's most famous energy trader, about how to navigate the oil markets and where it's all going. This starts on May the 2nd, and I'm going to learn so much about what really is going on and how to best navigate it. Yes, not everybody's going to be saying the same thing, but it's going to allow me to piece together an investment framework to navigate these complicated times. Now, normally we'd give you a 7-day trial for $1, but because this is so important for all of you, and I think it's one of the most important pieces of content we've ever done, we're extending that free trial for 2 weeks for $1. So you get the entire campaign of all of these great minds. And it's only $1 for all of this. So just go to realvision.com/global recession to find out more and join me as I try and figure out what the hell's going on.